Hi friends, if you're thinking to invest in Indian stock market either via stocks or mutual funds in the next few days or weeks, this video is extremely important video for you because in this video I'm going to speak about Indian stock market's valuations. Please remember that if you buy any asset which is overvalued, then the chances of you losing money is extremely high. Again, I'm not trying to scare you, but in this video, I will present to you some mind-boggling facts with data so that you understand the current situation. So we are going to look at Indian stock market valuations on 2 points. Point number 1 is we are going to compare Indian stock market's valuation versus emerging markets valuation and developed countries markets valuation as well. And the second point we are going to do is we are going to look at Indian markets historic valuations and where we stand today so that we get a good comparison. So let's start with point number 1. Let us compare where does India stands versus emerging markets. Now how to go about comparing this? Very simple. We are going to use some indices. I'm pretty sure you would have heard in the news a concept called MSCI indexes. For example, MSCI India Index. What is MSCI? MSCI simply is Morgan Stanley Capital International. It is the short form of that firm, and they have developed a lot of indices. And these indices help you compare various markets. I'm also going to use Nifty little later, but for now, let us stick to MSCI India Index. Now, I'm not going to explain to you what this MSCI India Index is and how it is built. That is going to be a separate topic in itself. But very briefly, MSCI India has got top 10 constituents, just like Nifty. And you can see the list here, likes of HDFC Bank, Reliance Industries, etc. Here, the weightage may be very different from what we see in Nifty. So this is not Nifty, it's a MSCI India Index. And the second index that we are going to consider is MSCI Emerging Market Index that takes into account top 10 companies, for example, let's say Taiwan Semiconductor Manufacturing, right? Or Alibaba Group, which is from China, a Korean company, Samsung. So it is now looking at various emerging markets and have compiled their tracking into one emerging market index. Now, if I come back and talk about the valuations, for example, MSCI India Index, if you look at the PE ratio, the current PE ratio is at around 26.71. Again, please do not get confused by Nifty PE ratio. Nifty PE is different. I'll come to that in a minute. Here we are talking about MSCI India's PE ratio 26.71. And if you look at the emerging markets PE ratio, it is 15.06, right? So clearly here, MSCI India is trading at a premium than emerging market. More importantly, if you look at the forward PE ratio for 12 months, you will note here that MSCI India's index is trading at around 22.93, almost 23, versus 12.68 by emerging markets. We are trading at almost 95%, almost 100% premium than the emerging market, meaning that we are overvalued compared to emerging markets like China, Taiwan, Korean, if you look at that at an index level. Also, if you look at ACWI index, which is all country world index, where you have developed countries like US, developing countries, and you have European countries as well. This index, even if you compare with this index, we are trading at a higher premium. It is at 18.37 forward PE, we are at 22.93. Now, before we say that this is a massive problem in terms of valuations, please understand that if you go back and look at the history, last 8 years, 10 years, you will find that Indian stock market have been consistently trading at a higher premium, higher valuations than emerging market, mainly because our GDP growth rate has been very high, 6 to 7% versus many other countries where they're only growing at, let's say, 2 to 3%. So we definitely command a higher premium in terms of valuations. But how much high is the question? If I now talk about some data points here, Jefferies very recently released their 10-year historical premium, and it comes out to be around 63% premium. That to me is acceptable figure. But right now we are trading at a very high PE, almost 100% than the emerging market. Therefore, there is definitely a caution here. There is definitely a question here that are we really trading at a very high premium than the emerging market? This is all data backed. Again, I'm not trying to give you my opinion, but definitely something that you need to look at. And this is all about large cap space. What about the mid cap and small cap? If you look at the MSCI India mid cap index, very similar picture here. For example, MSCI India mid cap forward PE is 35. But if you look at emerging market mid cap, it is only 13.61. I mean, this is crazy valuations right now, even in the mid cap space. If you look at small cap, very similar story here as well. If you look at India small cap, forward P is 26.89 and emerging market is only 14.42, almost 100% premium. The question is that are we continue to see this overvaluation, because we could remain overvalued for a long period of time. It also depends on the liquidity that we have in the Indian stock market and the growth prospects. But right now, if you ask me, we are trading at a very, very high premium than the emerging market. Therefore, big investors might be considering this as a factor, and there is a possibility that we might not see huge movements from here on. In fact, we might see corrections in the next few days. Again, nobody can really predict it very, very accurately. But from valuations perspective, I'm becoming extremely uncomfortable right now to pour a lot of money into Indian stock market. You really have to be very, very selective. I'll come to that in a minute in terms of our strategy. Now, this is from MSCI index perspective. Let's also look at Nifty's historical PE ratio or the valuations and where we stand right now. Before I do that, a big announcement that I have launched a series of podcasts coming your way by the name The Wealth Couch by Rahul Jain. 2 podcasts are already live. First one was with Zen Technologies chairman, Mr. Ashok Atluri. Very, very important podcast if you're looking for defense sector. And second one is with Info Edge India Limited's co-founder, Mr. Sanjeev Bikhchandani. Extremely rich experience is what I am trying to bring using these podcasts. I've created a separate YouTube channel just dedicated on podcast. You'll find the link of that channel as well in the description or in the pinned comments, or simply go and search for The Wealth Couch by Rahul Jain. These podcasts are also being released on Spotify. Again, you will find the link in the description and in the pinned comments. Go and watch these podcasts, and I'm pretty sure that you're going to learn a ton of knowledge from these podcasts. Now, coming back to our main topic here, let us also look at Nifty 50's PE ratio and compare from history perspective. What do you see? Current PE ratio at the time of recording this video in the early July 2025, PE ratio is at around 22.8. Now, if you go back and look at the history of the PE ratio, if you look at this pink curve here that you see, typically when it goes beyond 24 or 25, it starts to become overvalued territory. And when it dips to, let's say, 20, 21, this becomes fairly valued zone. Right now, it is already touching 23. One would argue that, is it overvalued right now? That's what we need to consider here. In my view, whenever Nifty PE ratio comes at around 20, it becomes a bulk buying position. For example, the recent correction we saw, there Nifty's PE ratio dropped to almost 19. And at that time, I had created this video and I talked about why 21,800 level of Nifty is extremely difficult to be broken, because the PE ratio of Nifty at 21,800 at that time was around 19 or 20. And it is extremely hard for Nifty to drop below that level from a PE ratio perspective. That's what history tells us. But right now, if you were to ask me, I would say that Nifty is slightly overvalued. I am personally not investing in Nifty right now. Again, not a recommendation. You do whatever you like. But if you look at Nifty from risk versus reward perspective, to me, Nifty looks slightly overvalued. Now comes very, very important question that what can happen to markets right now? For example, if you look at Nifty 50, back in almost October 2025, early October, Nifty was touching all-time high level of 26,000. From that time onwards, huge correction started. We saw Nifty dropping to almost 21,900 level. After that, it has gone back up to almost 25,500 levels. It's now coming down. The big question is that, can it now correct? Can the Indian stock market correct now, or will it continue to go up? Now, I cannot predict with 100% accuracy whether the market will go up or come down. But my thesis is that it will entirely depend on how the earnings in Q1 26 results look like. If Indian companies deliver stronger Q1 26 results, then the chances of market going up becomes very high. But if the Q1 26 results are not good, then in my view, there is likely to be a correction, or at the max, a sideways movement. We are not likely to see an upside, because as we talked about earlier in the segment, valuations are already looking very, very stretched in my view. And if the earnings do not support the valuation, then there is a chance of a correction. I do not know which way the results will go out, but the early signs of these Q1 26 results are not looking very, very great. For example, I'm going to run you through 3 companies which have already declared their results. Let's have a look at their results and see what is happening in there. So the first company that I'm going to discuss from a Q1 26 earnings perspective is TCS, Tata Consultancy Services Limited, number 1 IT company from India. Have a look at my screen, and I'm just going to simplify this very, very clearly for you. If you look at June 2025 quarter, where the results have come out, versus June 2024, last year, similar quarter, quarter 1, if you compare the performance here, you will note that In 2025, the revenues have declined by 1.1% in constant currency terms. Year on year, that have declined. Last year in 2024, the revenues were up by 3.9%. So clearly, the revenues have dropped for TCS. More importantly, if you look at the operating margin, that has also slightly contracted. It used to be 24.7% last year. It has come down to 24.5%. But more importantly, if you look at the net income, you will note here that this year it has only grown by 3.5%. Last year it grew by 8.7%. So there is a stark difference in terms of the growth of net income. This to me looks like that profitability is also taking a hit right now from a results perspective. The only good thing is that the net cash that TCS has generated is way high, almost 100.3% of the net income. It is $1.5 billion versus $1.34 billion. We all know that companies, Indian IT companies, are generating huge cash, but from a top line perspective and a bottom line perspective, definitely there is a slowdown in the growth in terms of the numbers. And if you read the CEO of TCS comment, what he's saying is that it is because of a demand contraction. Why would the demand contract? Simply because a lot of their business comes from US. And because of this all tariff drama that has been going on from the last 4 to 5 months, businesses are unable to make decisions. And when they don't make decisions, first thing they will halt is the IT spending. Possibly this is the reason that the spending has slowed down, and therefore the new contracts are not growing at a speed that we would like to see them growing for Indian IT companies. And one could argue that that is directly hitting the profitability of Indian IT companies. TCS is just an example. Other IT companies may be very, very different. And to be honest, we are likely to see the impact of tariffs only 2 to 3 quarters down the line fully, because this is just a Q1 results that have come out. And this uncertainty, I don't know how long this will last. In the news, we hear that Trump is now making decisions in terms of, negotiating the deals, etc. But we are likely to see the impact in Q2 as well. In my view, the Q2 results are not likely to be great when it comes to Indian IT companies at an overall level. There may be few Indian IT companies that might do better. We can't really speak about each and every company here, but TCS results are not great. Coming back, if you look at the verticals as well, you will note that almost all the verticals have declined. Consumer businesses 3%. BFSI grew by 1%, great. But consumer businesses degrew by 3%. Life science and healthcare, pharma, 9.6% decline. Manufacturing, 4% decline. Almost all of the verticals have declined. From a geography perspective, North America, clear decline, 2.7%. Latin America, much better. UK, continental Europe, all declining. Asia Pacific, much better. India declined by 21%. Huge surprise to me, actually. But anyways, if you look at overall growth here, TCS is right now showing the signs of degrowth. I don't know whether Q2, Q3 will be exactly like this or not, but in my view, because of the uncertainty, IT spending definitely has slowed down, and it may cause impact in terms of profitability. As a result of these, what has happened is the PE ratio of the company, TCS, if you look at the last 10 years historical average, has been, median PE has been around 26.7. It's almost coming to below that median PE right now. Could there be more correction? I do not want to speculate. Let me know in the comments what is your view in Indian IT companies. What is your view about TCS? Is it a good correction? Do you think it is just the cyclicity that will play out? Let me know in the comments. Let's just discuss this in the comments and learn from each other. And so far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Also, you can consider joining my YouTube community. It is an exclusive community where I put out daily content, daily posts. For example, the MSCI index that we talked about in the earlier section. Almost 8 months or 10 months back, I had broken it down very, very clearly. What is the MSCI index? What is the impact of that in terms of inclusion of stocks into that index, exclusion of the stocks out of that index? And more importantly, I keep talking about valuations, keep talking about stocks, mutual funds, ETFs, various assets. The feedback of this community has been excellent. If you want to practically learn, join this community. Simply go to my channel and click on join button, or you will find the link in the description. The second stock that we are going to discuss is IREDA, Indian Renewable Energy Development Agency Limited. Have a look at my screen. What you see is that they have very, very recently declared their Q1 26 results. From a loan book perspective, sanctions, disbursement, loan outstanding, very, very good growth rate, 29%, 31%, 27%. But I keep telling people that it is extremely easy to give out loans, but it is extremely difficult to collect the loans back. I've been working in a UK lending company for almost 7 years in my career, and I can tell you that it is so easy to distribute loans, but when it comes to collecting the loans back, that's where the hard part comes. Now, if you look at the performance of these companies, revenue and PAT, here revenues are fine, okay, not a major problem at all. 29% growth is what we are seeing. But if you look at the profitability, profit after tax, there is a 36% decline. It has gone down from almost 384 crores last year to now 247 crores. That is a massive dip in the profitability. Why? Simply look at the NPAs, which is the bad assets or bad loans. Gross NPAs have doubled almost, 2.19% last year, now 4.13%. Net NPAs, of course, will go up 0.95% to 2.06%. Why the gross NPAs have gone up? Mainly because they have given this clarification as well. They have talked about this, that one of their borrowers that used to be in stage 2 of the loan recovery cycle has now become NPA. That potentially is going to be a very, very big account for IREDA. Now, this is not necessarily a sign of a bad economy, because this is all about Indian market, not global market here. But one account defaulting definitely is a problem for this company in particular, but we can't say that there is a problem in Indian economy just because one company's one account have defaulted. What would be really interesting to see here is that what does REC comes out with in terms of numbers? What does PFC comes out with in terms of the numbers? What does banks come out in terms of the NPAs? And if we see that the overall NPAs are going up, that would indicate there is a stress. But just from an IREDA perspective, definitely a very, very bad quarter for them, unfortunate quarter for them. And that could happen to any company. And also other point is that if you look at the balance sheet of IREDA, you will note that the provisions that they've made in this quarter is only 743 crore versus last year 1003 crore. So they haven't really made a lot of provisions as well. If they've made a higher provisions, their profitability will take further hit. That is something that we need to keep in mind, that it's not necessarily that quarter 2 and quarter 3 is likely to be better quarters, because we don't know what we don't know. Is there anything good happening with IREDA? One thing that is good with them is that their bonds have been enlisted to be tax-free bonds now. What does it simply mean? That they will be able to borrow money using these bonds at a much lower interest rate, because these bonds are tax-free. Of course, the rate is not very, very high. But overall, my big problem with IREDA as a company is their high PE ratio. If you go and compare IREDA's PE ratio, even right now, it is at 28. And the question that I keep asking people is that how can REC and PFC, they can trade at around 6 or 7. Right now, they're trading at around 6 and 7 versus IREDA. They're exactly into the same business. Of course, IREDA is giving loans out to only the renewable part of the power sector. But still, I can't find any convincing reason for IREDA to trade at such a high PE ratio versus PFCs or RECs that are trading at much lower valuation. And that's why I keep telling people that if you're investing in any company, and if you end up buying company stock at a very, very high valuation, and if you get a one bad news, that's what has happened with IREDA here, one bad quarter, and all of a sudden the stock comes under pressure. Extremely important point for you to understand is look at the valuations. If you can't look at many things, just look at the PE ratio, look at the median PE ratio. Compare the PE ratio of these companies with their competitors and you will get a pretty good picture. The third stock very, very quickly I'm going to touch upon is Tata Elxsi. Have a look at my screen. You will read the commentary from their CEO and MD. Manoj Raghavanji, and what they're saying is that there is a macroeconomic uncertainty. And if you look at the numbers here, extremely bad performance in my view. Look at the revenues, they have come down 892 crores versus 926 crores last year. Y on Y basis, it has declined. More importantly, EBITDA and margins, if you look at 27.2% last year, same quarter, it's come down to 20.9%. I mean, 7% of erosion is huge erosion. PAT margin, if you look, 19.2% to 15.5%, huge decline. Prime example of how the fundamentals have gone upside down. This is what is happening right now, and this company operates in Europe, in US, globally, and you can understand why this is happening. Demand is contracting definitely. Uncertainty is there. There is not enough IT spending right now, and that's what is causing these issues. If you look at the headcount as well, attrition rate, if you look at 15%, it's gone up, meaning that the people who are leaving, those vacancies are not being backfilled very, very quickly because company might not be seeing the demand. This is the trend we are seeing in IT right now. I really do not want you to get scared, but this is the harsh reality. Let us wait for some more IT results to come out, and that's where we might conclude. I might need to create part 2 of this video to look at some other companies. Let me know in the comments if any other companies you would like me to look at their Q1 results and present to you part 2, include that in part 2. Do not guarantee that I will definitely do it. It really depends on the time and many other things, but let me know in the comments if you would like me to shoot another video. Overall, these 3 stocks so far have come out with their Q1 results. There may be few other companies, I can't cover all of them here, but definitely looking at these 3 good companies, reputed companies, you would see that there is an early sign of not seeing very good earnings. I do not know whether this is likely to be the cumulative behavior. There will be companies who will do better. There will be companies who may not do better in terms of Q1 26. So what should you do as an investor? 2-3 points I will make very quickly. If you want to invest right now, please be very cautious. Look at those stocks or companies where the valuations are very reasonable. In fact, look at those stocks that are beaten down heavily and fundamentally they are decent. I've created this video here where I talked about how can you go about filtering out beaten down stocks, looking at their fundamentals, etc. Go and watch this video. This is a good strategy if you want to invest in the Indian stock market right now, because there is a danger of correction right now. Therefore, you do not want to pick stocks that are highly overvalued. Look at the stocks that are beaten down. Look at bottom up approach here. Look at the stocks that are potentially sitting at bottom. Second key point is that should you actually sell some of your stocks? It really entirely depends on you. If you're a long-term investor holding your stock, sitting on it, okay with the volatility, then nothing really matters. But if you are sitting at huge profits, for example, and if you think that some of these companies are hugely overvalued and if the earnings do not come out really good, then of course there is a danger of correction. There is a risk of correction. And accordingly, you can decide what you want to do. I cannot really tell you whether you should go buy or sell. This video has given you a lot of insights, hopefully. And if you like this, request you to hit the like button. Check out my podcast channel because you are going to learn from the industry veterans directly. You're going to learn from chairmen, founders, experts, and it will increase your knowledge almost on a weekly basis. Link to the channel is in the description and in the pinned comments. And finally, I hope you enjoyed this video. If you did, hope to see you in my next video. Until then, keep rocking.